Good afternoon, ma'am. We are streaming live.
Yes, ma'am.
We are streaming live, ma'am.
Are you ready? Do you want to go on live now?
Yes, we are ready. We
Okay.
can start. Yes.
Have we gone live, ma'am? Shall we?
Yes. Yes,
Okay.
we can proceed.
Yes, ma'am. A very good afternoon. We were discussing bond valuation yesterday. Now, we discussed two aspects. One, the various risks associated with bond, and then the various yields which we have in bond. So before we get into the problems, let us just have a revision of that. Now, is this what we were discussing yesterday? The various risks associated with bond. First, we considered default risk or credit risk. Both mean the same. Default risk or credit risk is the risk which we have because of the issuer. That is the interest payment and principal repayment as per schedule. That is what we see in this. As a bond investor, my first concern is whether I will get my principal, whether there is principal protection, capital protection, and whether I will get my interest. Not just whether there is principal repayment, whether the interest is paid, it is also whether it is done on time. Because as we know, the one concept that runs through entire financial management is time value of money. Therefore, my interest is to see whether time value of money is there, means I want to know whether I'll get my principal repayment, whether I will get my interest repayment. Also, will it be on time? Because if it is not on time, there is no use. This is the first risk. And the default risk arises because of three things. What are those three things? One, the business risk. That is, based on the very nature of the business, certain businesses, industries are more risky. So this is what we try to address in the subject strategic management. Then we also have financial risk. This is what we address in strategic financial management. Then, of course, we have operating risk, which is what we address in strategic cost management. Now, when we say risk-free, risk-free means what is it we consider as a risk-free security? We consider government bonds, government securities as risk-free. Does it mean they are free of all risks? No, definitely not. They are free of only of all the various risks which we have. It is free of only default risk. That is all. Then the next risk which we are interested is marketability risk or liquidity risk. When a bond investor subscribes for a bond, there is a fixed period after which it will be redeemed. It's quite possible that he would like to exit early. So he is also interested in whether there is marketability, whether there is liquidity. So this risk is because of the bond market. Do we have a well-developed bond market? The risk of non-marketability of bonds is caused in the absence of a well-developed secondary market for bonds. Now, if you do not have liquidity, it may be necessary for the investor to exit at a huge cost. That is why we are interested in that risk also. Then, the moment we say bond, we are interested in interest rate risk. Now, what is interest rate risk? At the time of investing in the bond, I am looking at a particular yield. Will I get the promised yield? That is what I want to see. Now, the bond investors are subject to interest rate risk on two counts. Now, when I say the interest rate, the going interest rate has increased, the bond investors can be happy because the interest which they receive on the bond which they have already invested can be reinvested at a higher rate. At the same time, we know the going interest rate and the bond prices are related. They are inversely related, which means if the interest rate goes up, the bond price will come down. So they are subject to two things, two risks. Because of a change in interest rate, the bond investor faces two risks. What are they? They are reinvestment risk and price risk. Now, whenever I talk about an investment, the inflow which I have because of an investment, I make an investment to get an inflow. The inflow which I have from the investment, a fundamental assumption, whatever investment I talk about, whether I talk about bond investment, whether I talk about mutual fund investment, whether I talk about investment in the business, in a project, or I invest in non-current asset, anywhere and everywhere, investment, the reinvestment assumption is there. So I have, because of a change in interest rate, because of interest rate risk, I have two types of risks. That reinvestment risk and price risk. So what is the effect when interest rates rise? When interest rates rise, the periodic interest can be reinvested at a higher rate, and hence there is a gain on reinvestment. So because of this, the bond investor can be happy. But at the same time, there is an issue. What is the issue? The market price of the bond will come down because the going rate has increased, and then there is a capital loss. So there are two effects, opposite effects for a bond investor whenever interest rate changes. When interest rates fall, it is the opposite effect. Periodic interest can be reinvested only at a low rate, and hence there is a loss on reinvestment. The market price, the investor is not happy. But at the same time, the market price of bond will go up because going rate has come down, and then there is a capital gain. Now, why? What is the relationship between the going rate and the market price? Means we discussed the concept of yield to maturity yesterday. So, yield to maturity is the discount rate which we will use for finding the price, or put it the other way. Yield to maturity is the yield which the bond investor will get if he invests at the current rate and then holds till maturity. And we also saw the various assumptions which we have on that. So now we have seen these risks. What is the next risk we are interested? We are interested. Now we saw first about the issuer. Then we saw about the market. Now we will see about the economy. So the next one is inflation risk. We know that the required return is made up of three components. Any required return, whether we take capital investment or we take investing in equity or mutual fund or anywhere, required rate, which we use as the discount rate, is made up of three components. What are those three components? One is the real risk-free rate. Two, inflation component. And three, the risk premium. Now, each of these components is to compensate the investor for some sacrifice which he has made. Whenever someone makes a sacrifice, he has to be compensated. So each of these is for compensating a sacrifice which the investor has made. What all sacrifices does he make? So the first one is, if the investor invests, then he is sacrificing what is known as present consumption. That is, if I lend my money, if I invest my money, this money which could have been used for some other purpose, that I am sacrificing. So present consumption, when I make an investment, I sacrifice present consumption. So this sacrifice of present consumption should be made good. For this only, we have the real risk-free rate. Then, if you have an inflationary situation, what happens? There is loss of purchasing. So between the time I have now and when I actually get back that money, what I could have purchased now with this money, I will not get at that time. So I will have to be compensated for the loss of purchasing. So this is the inflation component. And the last one, of course, is the risk premium, because different investments have different risk. And I have to be compensated by means of a risk premium for the additional risk which I am taking. Now we saw the issuer, we saw the bond market, we saw the economy. Now we will see the country. Political and regulatory risk. Whether the political and regulatory environment is stable. Now, the bonds can be affected by changes in government policies, regulations, and changes in taxation, anything that can impact the investment. So that we have to see. Then we are not only looking at the domestic environment, we are also looking at the global environment. So you have what is known as the currency risk, which is there because of the forex market. And then there is something called a call risk. We will see a problem also on that. The callable bond, we will see. So call risk. Supposing there is a call option, then that also has to be considered, because that is a risk for the investor. We will see that in great detail when we come to the problem. And then you have what is known as duration risk. We discussed the concept of duration yesterday. What is duration? Duration is the holding period for which interest rate risk disappears. That is duration. So this part, because a clear understanding of the different types of risk, what they mean, and the different yields, that is necessary for us to understand this concept. So can I take it that this is clear? Let us move on to yields. This is done. Next, we will look at the concept of yield. Yield means return. We have various types of yield. Discount yield. What is discount yield? Now, note that all instruments will carry a coupon. So, if we do not have a coupon, you don't have a coupon for money market instruments. You don't have a coupon for zero coupon bond, which are issued at a deep discount. Therefore, discount yield is used to calculate the yield on money market instruments or zero coupon bonds. That is discount yield. Is even if there is no coupon, those investors who are investing in this should get some return, isn't it? What is the return? The return is the difference between whatever amount you invest now and whatever you get paid at the time of redemption. That will be your return. So when we find this, that is the discount yield. Now we also discussed yesterday that all yields, returns should be annualized, should be given as a percentage. It is a must. Next, we saw what is nominal yield or coupon yield. Nominal yield or coupon yield is the stated rate of interest on the bond. It is the interest expressed as a percentage of par value or face value. How do we compute it? Annual interest divided by face value of the bond. Now, any yield, any return is made up of two components. One, income. Two, capital appreciation. Now, if I look at this, I have only, we are interested in finding yield on investment. Yield on investment means yield is return. Investment is what you are investing now. The yield or the return is made up of two components, the regular income and the capital appreciation. Now, if you look at nominal yield, we take only the annual interest. That is, income part is taken, but capital appreciation is not taken. This is one flaw. Another flaw of this coupon yield, that is called nominal yield, only for namesake. The other problem is that I take face value and not the market price. So that is the issue which we have in nominal yield or coupon yield. So one of the issues which we have in nominal yield or coupon yield, we try to set it right in current yield. That is, we look at what is the annual interest, but the denominator, I take current price. So this is current yield is current. Normally we know current, when we say current asset, current liability, we take a period of 12 months. That is why here also we are taking annual interest. Current price of the bond. When we say current price of the bond, we have set right one of the issues which we had in nominal yield. We are taking the current market price. If you invest at the current market price and hold on for 1 year, what is the income you will get? Next is the most important yield, which is equal to maturity or redemption yield. We already discussed yesterday that yield to maturity is the internal rate of return. In capital investment, we will say internal rate of return. In equity, we will say return on equity. In bond, we will say yield to maturity. They all mean internal rate of return only. Now here, the reference is to the current market price. If you invest at the current market price and hold on to maturity and also make the reinvestment as and when you get the periodic interest, then you will have yield to maturity to be whatever is the realized yield. So we saw three scenarios when we talk about yield to maturity. If the current price is equal to maturity value, we said yield to maturity will be equal to coupon rate. If the current price is less than maturity value, yield to maturity will be greater than coupon rate. And if the current price is greater than maturity value, we said yield to maturity will be less than coupon rate. So there are certain assumptions underlying YTM, which we discussed. The bond is invested at the current market price and held till maturity. So we are referring here to the cash outflow and the holding period for the investor. The cash inflows from the bond are fully and immediately reinvested at precisely the same interest rate as YTM. So this is again the responsibility of the investor. Then the third assumption is all coupon and principal payments are made as per the schedule. So this is the responsibility of the issuer. We are assuming that things will happen. Now, required yield. What is required yield? Required yield is a minimum yield which the investor requires from a bond. It consists of two components. One, the risk-free rate, which is determined by the yield on government securities. Now, normally, if nothing is mentioned, whatever yield is given, whatever cost is given, we assume that it is nominal. Therefore, whatever we have, that we will take, that is nominal. So inflation component is already incorporated in that. And then the risk premium is determined based on the credit rating of the instrument. So if the credit rating is good, risk is less, so premium is less. If the credit rating is bad, risk is more, so premium is more. The required yield is used as the discount rate to find the intrinsic value or fair value. Yesterday also we saw a problem where we found the intrinsic value. Is this clear up to this? Then of course you have realized yield. We discussed already along with YTM what is realized yield. We even did a problem yesterday. YTM, that is yield to maturity, and realized yield will be the same. The assumptions of YTM are valid. Realized yield is a return earned by the investor over this holding period. So any violation of the assumptions will cause realized yield to differ from the YTM. Then lastly, you have the concept of equivalent yield. Equivalent yield restates the semi-annual or quarterly or monthly interest bonds into an equivalent annual yield bond. So if we have different fixed income securities whose interest payments are not annual, then I want to compare. What is it we saw yesterday? A fundamental principle is, what is the fundamental principle? Fundamental principle is that the base information on which you make a decision should be made comparable. So that is what we saw. Next, we see the concept of duration. Duration is the weighted average maturity of a bond where the weights are the related discounted cash flows in each period. It is the holding period for which interest rate risk disappears. What is duration again? Duration is the weighted average maturity of a bond where the weights are the relative discounted cash flows in each period. It is the holding period for which interest rate risk disappears. This is the connection between duration and interest rate risk. That is why for a change in interest rate, what happens to the price? We used the concept of duration. We found duration, we found volatility, then we found convexity. If you have bigger, larger changes, then we said duration is not good enough. There should be some correction factor, adjustment factor for duration. That also we saw a problem yesterday. So bond duration, that is the concept we saw. Then of course the concept of bond volatility. We know that bond price and interest rates are inversely related. Changes in market interest rates cause bond price to change in the opposite direction. The duration of a bond helps in measuring the sensitivity of the bond's price to interest rate movements. So what is bond volatility? It is a measure of sensitivity of the bond's price to change in market interest rates. Bond volatility gives change in bond price as a multiple of change in interest rate. In other words, what is bond volatility means? Bond volatility is to bond what beta is to equity. Beta, what is it? We know what is beta, isn't it? We will be discussing that when we do portfolio management also. What is beta? Beta gives you, it's a sensitivity measure. It gives you how much the price of equity, any share, will change with a given change in market. There, the sensitivity, the volatility of the equity share is to the market. Now here we are referring to bond. For bond, which is the factor which influences the bond, it is the interest rate. So volatility to a bond is like beta to equity. So we also discussed the steps to find duration. There are two ways in which we can find duration. One is the formula, the other is just using the concept. So what we discussed is first we will find year-wise discounted cash flows using YTM as the discount rate. Then current market price will be the total of the discounted cash inflow. Then we said we will multiply year and discounted cash inflow. Duration will be the total of year into discounted cash inflow, sigma year into discounted cash inflow divided by current market price. This is one way of finding it. Then we also saw that we can use the formula which I displayed yesterday, 1 plus YTM divided by YTM minus 1 plus YTM plus N into C minus YTM divided by C into 1 plus YTM to the power N minus 1 plus YTM. No, it is too much bother. You have many papers where you have to strain your memory. Now, AFM is so nice that it doesn't trouble your memory at all. So we can use that. Better we use the concepts and do instead of looking at the formula. Also, formula cannot be used under all situations. So, knowing the concept-based computation for duration might be better. Then bond volatility, we said duration divided by 1 plus YTM. That is the original YTM. Then expected change in price. That is why we said we can even have the formula as minus duration divided by 1 plus YTM. Because they are inversely related, put a minus. If there is a reduction, automatically this will come as plus, so the price will increase. If there is an increase in the interest, because I put the minus, automatically this will show that the price will come down. So I told you it has only limited application. I cannot use the formula always, I told you. When I cannot use the formula means, if you look at the formula, which I displayed yesterday. Maybe we will display once again. Now, this is the one based on concept. That is, duration is equal to year into discounted cash flow. Year means period. It can be year, it can be half year, it can be quarter. That doesn't matter. So, sigma year into discounted cash flow divided by current market price. This is based on the concept which we saw. What is the concept? We discussed what is duration, isn't it? What is duration? We started the class with that discussion only, isn't it? What is duration? Duration of a bond is the weighted average period of a bond where the weights are the relative discounted cash flows in each period. So we can look at the weights and then do, or alternatively, this is the formula. 1 plus YTM. YTM stands for, of course, yield to maturity. Then C stands for coupon rate. And N stands for years to maturity. Now you find that in the formula, there are just three terms. N, C, YT. That is, the formula does not consider early repayment, part redemption. So that cannot be used in such a situation. If the investment is made in installments, then also we cannot use. Supposing the coupon rate keeps changing, then also we cannot use. These are the limitation of using the formula. But the based on concept what we have, this is easier. You don't have to remember anything, and it can be applied all the time. Then I would much rather prefer going by the concept rather than going by the formula. Formula has limited application. Also, you have to strain your memory. With all that, duration would be, we can compute it much better when we are looking at the concept-based thing. So, up to this, okay. Now, we also discussed convexity. Convexity provides additional insight beyond the duration. Convexity is the correction factor. Because when small change in interest rate happens, duration is okay. But if the interest rate is more, the change in interest rate, large interest rate changes, then we cannot use duration. We would much rather use convexity. And we also took a problem where we saw without convexity adjustment, what we got, with convexity adjustment, what we got. And we found that when we computed the intrinsic value using the actual rates without the convexity adjustment, if we do, the variation was more. With convexity adjustment, if you do, the variation was less. So using convexity adjustment is a much better way of doing it. This is what we saw. So after this, okay. Now this is what, this is a briefing which we had on this chapter, bond, which we did yesterday. Of course, advanced capital budgeting, we completed yesterday. And now whatever we did yesterday regarding bond, we had a quick revision now. So now we can get into the next area in bond. So we discussed question 1, question 2. We have to do question 3 now. This is what we have to do. Can you see what I am sharing? You have to do problem number 3. Now, always I have suggested you that you need to read the requirement first. Let us look at the requirement of this problem. Calculate straight value of bond. See, the correct way of questioning that would be value of a straight bond. What is the correct way of doing it? Value of a straight bond. Not straight value of a bond. There is no straight value, crooked value. It is value of a straight bond. Straight bond means regular bond. That is a bond without conversion option. Now, but whatever is asked in the question, same thing I will take. I will not change it. But only when we are discussing, I'm telling you, straight value of a bond is not the proper way to put it. Value of a straight bond would have been much better. Straight bond or regular bond means the bond without the conversion option. Then conversion value of the bond, conversion premium, percentage of downside risk, conversion parity price. These are the things they want you to find. GHI Limited, a AAA rated company, has issued fully convertible bonds on the following terms. Again, the rating is for the security, not for the company. Normally, the rating is given for the security only. Same company has issued many securities. Each one could have a different rating. So the rating goes with the security. Face value of the bond is given, coupon rate is given, time to maturity is given, interest payment when that is given, principal repayment when that is given, conversion ratio 25 shares per bond. Current market price is there. Market price convertible bond is there. AAA rated company can issue plain vanilla bond, straight bond, regular bond, plain vanilla bond, all means without any frills attached. No frills. Only plain vanilla, regular, straight. So nothing extra. That is the meaning. Convertible bonds are bonds that can be converted into equity shares of the issuing company. So they give the bondholder the option to convert the bonds into a predetermined number of shares in the issuing company. So initially, they will act as regular bond only. But the convertibles can be exchanged for equity shares, and the investors are benefited when there is a rise in the price of equity share. There is some advantage for the investor, and hence companies offer lower coupon rate on convertible bond as compared to bonds without conversion option. We find that here itself. What is the rate they are offering? 8.5%. What is the going rate? 9.5%. For the one without the conversion option, it is 9.5%. They are giving only 8.5% because the investor has the option. So straight value of the bond, meaning what should be the intrinsic value, straight value of the bond, what it is that you see. Then conversion value of the bond. Straight value of the bond means, had it been a bond without the conversion option, what would be its price? So we will look at each one of these in up to this. We are clear, isn't it? What we are doing. So now, first we have to find what is the value of the bond, value of the straight bond. That is what we have to see. So you have understood the question. Now let's see how we need to solve this. I know the face value of the bond, I know the coupon rate, I know the years to maturity, I know the interest frequency, what is the annual interest I'll find, what is the maturity value I'll find, then what is the interest rate. This would be the required rate because you want to find the straight value of the bond. So what is the annuity factor, what is the discount factor, present value of interest, present value of maturity, what is the total value. Now this is the first requirement, finding the value of a straight bond. Since the question has used the term straight value of a bond, I have also said straight value of a bond, but it is value of a straight bond, value of a regular bond, or value of a plain vanilla bond. This is the first requirement. What is the second requirement? Second requirement is conversion value of the bond. What do you mean by conversion value of the bond? Conversion ratio, that is number of shares per bond, is 25. Current market price 45. Therefore, what is the conversion value of the bond means 25 into 45. The third requirement is the conversion premium. What do you mean by the conversion premium? The convertible bond has some value. The equity shares into which it can be converted into has some value. Conversion premium is the amount by which the price of a convertible bond exceeds the current market value of the equity shares into which it can be converted. So a convertible bond is generally sold at a premium over the equity conversion value. The conversion premium will decrease if the stock price increases, and with a longer period of maturity, they will have a higher conversion premium than bonds with a shorter time to maturity. They will have a lower conversion premium. So what is the conversion premium? The market price of the convertible bond is 1175. But conversion value is only 1125. So you are paying a premium of 50. This is for one bond. One bond you'll get 25. So per share it is 2. Is this over? Next. What is the next requirement? Percentage of downside risk. Conversion premium, you can give it as rupees, you can give it as premium. Normally, premium discount and all, giving it as a percentage is preferable. Now, next, downside risk. What is downside? The downside risk of a convertible bond is the maximum potential decline in the price of the convertible bond. When it will come down if the conversion option becomes worthless. So it is the difference between the market price of a convertible bond and the price of a straight bond. So without conversion option, with conversion option, what is the difference? That will be the maximum for. Market price of the convertible bond is 1175. At the most, it can fall only to this without conversion option. So that difference. Again, it's percentage of downside risk you want. So it has percent. Conversion parity price. What do you mean by parity? Same. So conversion parity price is the price that an investor effectively pays for equity by purchasing a convertible bond and then exercising the conversion option. Conversion parity price is equal to the price of the convertible bond divided by the number of equity shares into which the convertible bond can be converted into. So the concept of convertible bond, is it clear? Shall we move on? Next, we are looking at, I told you we will be discussing call risk, and we will be doing a problem in callable bonds, which is what we are going to do next. Now, what is the feasibility of refunding bonds? That is a question. Always I suggest read the requirement first, then go to the problem. Now, first of all, before we solve this problem, we need to know what is the meaning of callable bond. Callable bond, you have putable bond. So we need to know what is a callable bond, what is a putable. So you have what is known as embedded bonds. What are embedded bonds? An embedded bond is a bond that is embedded with an option that can either be a call option or a put option. Now I'll ask you a question. Is it possible to have a bond with both a call and a put option? These bonds are called embedded bonds because the call or the put option is embedded in the bond at the time of issue itself. You can't do it later. It has to be at the time of issue itself. At the time of issuing the bond itself, the terms governing the bond are embedded. The terms governing the bond, meaning coupon rate, frequency of interest payment, maturity, etc. Terms governing the embedded option is the lock-in period which you might have. What is the strike price? What is the schedule? That one. There would be a lock-in period during which it cannot be exercised, whether we talk about a call option or a put option. So now, what is a callable bond? Callable bond, putable bond, you have also studied at the intermediate level itself. You will have the callable bond, putable bond matter. So now, what is a callable? Callable bond are a bond with an embedded call option. So what is the advantage? They allow the issuer to alter the tenor of the bond by redeeming it prior to the original maturity date. Say, if the issuer has the option that the bond can be redeemed, when will he do that? If existing bond has higher interest rate. Supposing interest rates are falling, the issuer might as well exercise the option. Now, is it risky for the investor? Why is it called a risk means? Yes, it is risky for the investor. Because if the issuer gives back, then they have the problem of reinvestment. Because now the general interest has fallen. He won't be able to invest elsewhere at a higher rate. So to compensate them for the higher risk which they are taking, they are given higher interest rates. They may also give a call premium. If they recall early, they may give premium. So what is a callable bond is clear. Next, what is a putable bond? Putable bonds are bonds with an embedded put option. If call option is for the issuer, put option is for the investor. So an investor wants to redeem before the maturity date. Can he do so? Yes, provided there is a put option. A put option gives the investor the right to redeem a low coupon paying bond and invest in high coupon paying bonds because now the market rates have increased. So what he will do, he will exercise the option to redeem old bond with a lower interest rate and invest in a new bond with a higher interest rate. Now we may wonder whether it is possible to have both put and call option. It is possible. Put and call option is a two-way exit option available both for the investor and the issuer. The investor's option to exit is a put option. The issuer's option to exit is a call option. So I think up to this, it's fine. I'll give you some time. You can try the problem, then we can discuss it. So looking at the problem, what do we know? Mrs. Trans India Limited is contemplating calling 3 crores of 30 years, 1,000 rupee bond issued 5 years ago with a coupon interest of 14%. Is contemplating calling, means it's a callable bond. The original tenor of the bond is 30 years. The original tenor of the bond is 30 years. Already 5 years gone. It was issued 5 years ago. Therefore, now another 25 years remaining. The bonds have a call price of 1140. We already saw that you can have a premium redemption price if the bonds are called. So that is why, even though they are 1,000 rupees bond, 1140. Initially, the company had collected proceeds of 2.91 crores. So there has been a discount. The initial floating cost is given. So up to this, okay. The company intends to sell 3 crores. So again, same amount. 12%. We find that the interest rates have fallen now. 25 years bonds. So remaining period also in the old bond is 25 years. Here also you want only for 25 years. To raise funds for retiring old bond. No, they are not the old bond holders. If they accept this, they will be compensated with a higher redemption price. So it wants to sell the new bonds at the par value of 1,000. Estimated flotation cost given. Company is paying 40% tax stated. After tax cost of debt given. The new bonds must first be sold and the proceeds then be used to retire old bonds. They expect a 2-month period of overlapping interest, during which interest must be paid on both the old and the new bond. This is the position. So now, any proposal, investment proposal, we know there are three types of cash flows: operating flow, initial flow, net present value. So our first job is to find operating flow. Now you can do it total basis or you can do it incremental basis. Incremental basis means only the difference we take. Total basis means we take the total and finally compare and see which is better. So what are all the things to be considered? First, I am entering into this proposal only because it is possible for me to, and when I'm talking about me, I'm talking about the company's perspective. Only now it is possible. So what they do? They are doing it only because the interest rates have fallen. Instead of giving a higher interest rate, they can give a lower interest rate. That is the reason why they want to go ahead with this. Statement showing annual operating cash flows. Three cash flows are there: annual operating flow, initial flow, terminal flow. First, we are interested in the annual operating flow. Old bond, new bond, then the this is total approach. The incremental I have given you. If we follow incremental approach, we should take it. Otherwise, we can. So, what is the bond face value? What is the interest rate? So, what is the interest amount? It's mainly for the lowering the interest amount. We are taking this. So, what is the tax savings on interest? Any item, we want to know what is the tax savings. We have to take the allowable expenditure, multiply with the tax rate, then we will get. What is the interest cash outflow? That is the total gross amount minus the tax savings. I'm looking at what is the net amount. If I have to follow incremental, I should just take the difference of 3 lakhs. Then flotation costs for the old bond, for the new bond. For the old bond, years to maturity 30, you have to spread it over 30 years. For the new bond, over 25 years. Therefore, what is the amount? What is the tax savings? So now, apart from this, there was a discount given. So that also for the old bond, you have the benefit. So that's how much we will see. So all put together, old bond means what is the commitment? New bond means what's the commitment? Is that a saving? That is a question. So final position. Either I could have just taken the incremental items and found the savings annual operating cost to be 3,49,600, or alternatively, for old bond how much, for new bond how much, what is the saving which you are likely to have if you go for the new bond. Now, if this is done, the initial cash flow. We have to see what is the position. What is the position for the initial cash flow? Having found the annual cash flow, what is happening to the initial cash flow? So, call premium amount you are going to pay, and that amount you are paying, what is the tax savings you have? Therefore, what is the net flow? That is, we consider how much we are paying for the old bond. There is a cash outflow, not just for the face value, also for the premium. Then what is the tax savings you will get? Therefore, what is the redemption outflow? Now, when you issue new bond, there is an inflow, but there is a flotation cost. So what is the net cash inflow? Overlapping interest has to be paid for 2 months. That I consider, because even I started paying the interest on the new bond, old bond also I have to pay. So that old bond, what I am paying, what is the tax savings there? So what is the net? Now, the flotation cost and discount associated with the old bond has to be spread over the life of the bond. Now, if I return the old bond, then I have to immediately I can claim all the entire amount, unamortized amount. So that also I consider. What is the tax savings on that? That I consider. So we have considered the operating flow, we have considered the initial flow. Now terminal flow becomes irrelevant because for both options, I'm going to repay the same amount exactly at the same time. Therefore, that is irrelevant for my decision. So now, what do I know? Annual benefit I have for 25 years. That is future value, discount it, use the annuity factor, find the present value of operating cash inflow, deduct the initial outflow. You find that the net present value is positive. Therefore, you are interested. So is it clear? Annual operating cash flow, that is savings which we have, that's for a period of 25 years. Apply the annuity factor, get the present value of operating cash inflow, deduct the outflow, get the net present value. Now we are ready to take up the next problem. There are a few concepts which we have with regard to this problem, what we have learned, what we have applied. What are the concepts we have learned? Now, the discount rate which we have taken, it is given its after tax cost of debt is 8%. But what we know is the new bonds. See, whenever we talk about cost of capital, whenever we talk about required rate, we talk about discount rate. We can take cost of capital or we can take required rate of return. Cost of capital can be weighted average or overall cost of capital, marginal cost of capital, or opportunity cost of capital. When we say it is the overall cost of capital, when we use existing funds, we can do that. Marginal cost of capital is when, for the specific purpose, we raise money. The new bonds are being issued with the specific purpose of redeeming the old bond. So what is applicable here is only the marginal cost of capital. That is, the interest rate on new bonds is 12% after adjusting for tax or even flotation cost. I should take 7.3%. Now, why we are taking 8% means the new bonds, the problem is silent whether they are callable or not. So what is it we infer? Because nothing is mentioned, because if it is a callable bond, they should state what is the call price. All those things they have to state. They are not stated. So it is inferred that the new bonds are non-callable bond. Therefore, they are riskier than the old bonds. Hence, it must be assumed that the cost of debt given in the problem is the risk-adjusted cost of debt after considering the risk premium. Now, tax savings associated with the initial period cash outflow is considered at that time itself. Then the discount on redeemable bonds, flotation costs, etc., as I already told you. If the life of the bond is there, remaining years to maturity, proportionately it will be allowed. But if I redeem early, if I retire it, then the entire unamortized portion will be considered immediately. The overlapping interest of old bonds for the first 2 months, I'm not considering time value of money because it's just question of 2 months in a period of 25 years. I've already given you an explanation as to why we consider the terminal flow irrelevant, because the time is the same, 25 years. The price, redemption price is the same 1,000 for both bonds. Therefore, that becomes irrelevant. Are you clear with this? Next, we can consider yield curve. That is what we are going to do next. Yield curve, term structure of interest rate. What is a yield curve? The yield curve is a graphical representation of the yields of bonds of equal credit quality but different maturity dates. We are looking at a graphical representation of the yields of bonds of equal credit quality but different maturity dates. So I plot the yield on the vertical axis and the time to maturity on the horizontal axis. The yield curve shows how the yield to maturity is related to term to maturity for bonds that are similar in all respects except maturity. There are different theories for yield curve term structure. There are different theories. What are the theories? We have what is known as market expectation or pure expectation theory. This theory assumes that the various maturities are perfect substitutes of each other. As per this theory, the long-term interest rates can be used to forecast the short-term interest rates in the future. Long-term interest rates are assumed to be unbiased estimate of the short-term interest rate in future. The rates on a long-term bond, they are equal to the geometric mean of the yield on a series of short-term bonds. So what is it we are telling now? If the investors have an expectation of what 1 year interest rate will be next year, the 2-year interest rates can be calculated as the compounding of this year's interest rate by next year's interest rate. So the theory suggests that the yield depends on market participants' expectation of future interest rate. These expected rates, along with the assumption that arbitrage opportunities are non-existent, or if it is there also minimal, then we have enough information to construct complete yield curve. So, this is one theory, market expectation or pure expectation or just expectation theory. Then we have what is known as liquidity preference theory or liquidity premium theory. This theory, what is it? It is a variation of the pure expectation theory. The liquidity preference theory goes with the market expectation theory. It asserts that long-term interest rates reflect investors' expectation about future. But there is also a premium for holding long-term bonds. That is, the investors prefer to block their money for the short term rather than the long term. That is the assumption here. And the premium compensates investors for the additional risk of having their money tied up for a longer period, including the price uncertainty. Now, long-term bond yields tend to be higher than short-term yields because of the premium attached. Then you have what is known as market expectation. First we saw market expectation, then we saw liquidity preference, then we are looking at market segmentation. Market segmentation theory the bonds of different terms are not substitutable. The interest rate for short-term and long-term instruments, it is determined independently in the respective markets. The supply and demand of the two markets are assumed to be independent. So prospective investors decide in advance whether they need short-term or long-term bonds. If investors prefer their portfolio to be liquid, they will prefer short-term investments over long-term investments. Market for short-term instruments will receive a higher demand. There is a variation of this known as preferred habitat theory. And according to this theory, they have distinct investment horizons. They need a meaningful premium to buy bonds with maturities outside the preferred maturity. So we will just take a short break before we continue. So we discussed four theories. What are those four theories we discussed? We discussed market expectation or pure expectation theory, liquidity preference theory, market segmentation theory, and preferred habitat theory. These are the theories we have discussed. We will look at a problem. As far as problems are concerned, you will get only regarding expectation. Market expectation theory is the only one for which we will have problems. So we will see a problem in that. Let's try this problem. Yes. So what do we know? We are going to do market expectation theory. Market expectation theory, what does it mean? It means that the short-term interest rate and long-term interest rates are perfect substitutes. So now how do we go about this? There are two things here. One, the rate for year one, and then the 2 years rate now. We also have the rate for year two. Market expectation theory is, if we have the 1 year rate for year one we have the 1 year rate for year 2. With this, we can construct the 2 years rate now. So if you look at the problem here, in the problem, we have 3 months, 6 months and all. That we are not interested. 3 months, we are interested only if we want for 6 months. 6 months, we are interested only if we want for 1 year. 1 year, we are interested when we want for 2 years. So now you have 1 year rate. We denote 1 year rate for the first year as R1, 1 year rate for the second year as R2, and 2 years rate now as Y2. So 1 plus Y2 squared is equal to 1 plus R1 into 1 plus R2. Substitute the figures, get R2. So once we have R2, what we need to do is now we are interested in finding the forward rate for year 3. 1 plus Y3 cube would be 1 plus R1 into 1 plus R2 into 1 plus R3. In the problem, we have information regarding 3 years and above, what is the rate, which is 12%. So what do we have? 1.12 cube is equal to 1 year rate for first year, 10.5%. 1 year rate for second year, 12%. 1 year rate for third year, we have to find, solve. Once this is done, what does the question ask you? Based on the expectation theory, calculate the implicit 1 year forward rates in year 2 and year 3. That is, rate for 2 years now is 11.25%, which is Y2. Rate for 3 years now is 12%, that is Y3. What they have asked us to find is R2 and R3. Now we go to the next question. If the interest rate increases by 50 basis points, what will be the percentage change in the price of the bond? Let us see that. If the interest rate increases by 50 basis points, what will be the percentage change in the price of the bond having a maturity of 5 years? At present, the bond is fairly priced at face value 1,000. Try that, please. Now, because we know that the maturity is 5 years, I know 12% is the rate I'm talking about. 12% is what rate? Is yield. 12% is yield means coupon rate is also 12% because the current market price, it is stated it is fairly priced at 1,000. So maturity value and current market price are same. I can even verify that. I will find that it is 1,000. It increases by 50 basis points means now it becomes 12.5%. So I should find out what is the percentage change. So The 50 basis points increase, 12.5%. So the price drops to 982.16. Percentage change in the bond, if you say, there is a decrease of 1.784%. Now, what these things exactly mean, if you want to know, what we are saying is, if you invest for 2 years at 11.25%, the effect is the same as investing for 1 year at 1 year rate for R1, and then again in the second year at the 1 year rate R2. Both will give the same result. That is the meaning of this. The short-term interest rates and the long-term interest rates are perfect substitutes. That is the meaning. That's what we are saying, and we do this. Let me just explain to you what we are doing. See, as I was telling you, saying that the short-term interest rates and long-term interest rates are perfect substitutes is that if I invest for 1 year at the first year rate, again I invest for 1 year at the second year rate, the effect will be the same as investing for 2 years rate, for 2 years at 2 years rate. So here in this problem, what did we have as R1 10.5%? What do we have, that is we found as R2 12%. So let us say I am investing 100 rupees for 1 year. Then again I invest 100 rupees for 1 more year. I'll get 123.76. This is the case where I'm investing for short term, just for 1 year. Case 2 is I am investing 100 for 2 years. 2 years, what is the rate? 11.25% by 2. If I do that, how much I get? Same amount is what we are saying. Now, what are the things we have seen in bond? First, we saw the various risks, the various yields, interest rate risk, duration. Then we spoke about conversion. We did convertible bonds. Then embedded options, bonds with embedded option. We did callable bonds. Then we discussed yield curve, the different theories, yield curve theories or term structure theories, where we saw 4 theories. And as far as problems are concerned, only market expectation, where short-term and long-term are perfect substitutes. That's what we will get. So we saw a problem in that also. This is what we have done. Next, we will be taking equity. So let me stop sharing this. And before taking up equity, let's have a break. Then we will continue. Welcome back. Shall we continue? Next, let us move on to equity. The first thing we would see is regarding bonus issue. What happens? Now, the essential difference between equity and bond is that for equity, we do not have fixed payment. Then the investment in equity is not just for receiving the dividend. It is mainly for capital appreciation. In equity, Gordon's model, that is the constant growth dividend capitalization model, is a very important model. And should Mr. A buy the share? If so, what maximum price should he pay for each share? Assume no tax on dividend income and capital gain. Mr. A is thinking of buying shares at 500 each, having face value of 100. He is expecting a bonus at the ratio of 1:5 during the 4th year. 1:5 means one share for every 5 shares will be given as bonus. Annual expected dividend is 20%, and the same rate is expected to be maintained on the expanded capital base. He intends to sell the shares at the end of the 7th year at an expected price of 900. Incidental expenses for purchase and sale of shares are estimated to be 5% of the market price. He expects a minimum return of 12%. So you can try doing this, then we can discuss. Whenever we want to find the intrinsic value for something, we need to take the future cash flows, discount it at the required rate. What are all the cash flows we have to consider? You have to consider the dividend which you'll get for 7 years, and you also have to consider the price at which he can sell. The problem says at the end of 7th year, he can sell at a price of 900. But you have incidental expenses for purchase as well as sale at 5%. He expects a minimum return of 12% per annum is given as a required rate for the purpose of discount. Now, what is the dividend? Is there any mention as to how many shares he has bought? We can assume he is buying 5 shares because the bonus is 1:5. So let us say he purchased 5 shares. He will get a dividend at 20% on face value. So for years 1 to 3, he'll get a dividend of 100. There is a bonus in year 4. So the number of shares held during years 4 to 7 would be 6, and he'll get a dividend of 120. The share price at the end of year 7 when he wants to sell is 900. Selling expense is 5%. So 45 rupees he has to give. Net selling price will be 855. Therefore, he will get 855 into 6 as the cash inflow. So the cash inflows from holding this equity share by means of dividend and the price is that clear? So we have the present value of cash inflow for 6 shares to be 2,819.91. Is this clear? Now, once this is done, should Mr. Roy A buy the A share? If so, what is the maximum price should he pay for each share? So present value of cash inflow for 6 shares is 2819.91. With this, we need to work out what is the price. What is the maximum price he can pay? That also we need to compute. We have the present value of cash inflow for 6 shares to be 2819.91. Therefore, what is it for 1 share? We find that the net present value, that is, after considering the present value of cash inflow for 1 share, purchase price for 1 share, buying expenses. So, net present. So he has to buy the share because the net present value is positive. What is the maximum price he can pay means the present value of cash outflow can at most be the 563.98. This has to include the incidental expenses. So what is incidental expense? How much? What is the maximum price that can be paid? Is this clear? Completed this, we can move on to the next problem. Is this done? Is it clear? Let's move on to the next one. What is the next one? The next one, there is a discussion regarding free float. So what is free float? We need to know what is free float. What do you mean by free float? Free float market capitalization takes into consideration shares issued by the company that are readily available for trading in the secondary market. It excludes locked-in shares that will not come to the secondary market for trading in the normal course. Free float, which is freely available for trading, that is free float. What are the shares that will not come? Holdings by promoters. If the government is a promoter, then government holding. Whatever holdings are there through the FDI route. People who have, persons who have controlling interest. So any locked in share that will not come in the normal course. That is what we will have as free float. What does it say? We are required to find P ratio, bonus ratio, market price before and after the issue of bonus shares, free float capitalization of the company after the bonus shares. So, Tripti company, promoted by a multinational group, is listed on a stock exchange holding 84%. And that 84% represents 63 lakh shares. Profit after tax is given. Free float market capitalization is given. As per the SEBI guidelines, promoters have to restrict their holding to 75% to avoid delisting. Board of directors, they have decided not to delist with SEBI guidelines. So they will issue bonus shares to minority shareholders. Same PE ratio will be maintained. That is what is given. So how do we go about doing this problem? You can please try the problem, then we can discuss. We have the present promoters holding. Number of shares held by them is given. So if this is 84%, what is 100%? We'll find. Number of shares held by minority, we can find. What is the free float? Therefore, market price. Profit after tax is given, earnings per share is there. So we can find the price earning ratio. Proposed holding is given. So whatever they had, that should represent 75%. So what will be the total number of shares? How many shares will be there for minority? Bonus ratio. They already hold 12. Now 9. So 3 for every 4. Earnings per share, how much will it be? Market price. Because same price earning ratio is maintained. After bonus issue, how many shares they'll hold? What is the free float market capitalization? Alternatively, we can simply take the total market capitalization, propose minority 25%. You can find out what is the free float market capitalization. Next, let us move on to the next problem, which is about buyback. The first requirement is to find the expected return and variability of returns of equity shares. Then the next requirement is to advise whether or not the following information is available for an equity share. Market price after 1 year and dividend. Market condition, 3 such conditions are given: good, normal, bad, probability, market price, what is the dividend per share that is given. Now, existing price of equity share is given to be 106, which is count. Then the company has offered to buy back debentures. Find expected return and variability of return of equity shares. So that is the first requirement. Expected return, as always, we take the various prices, multiply the probability, and add sigma px will be the expected return. The expected return of equity is what is asked. The market price is also for equity. The 3 possible prices given: 115, 107, and 97. That is for equity. Now, the 106, which is the existing market price given, that is not just for equity. That is for equity as well as bonus debenture, which is 6. So, for equity portion alone, it is 100. As we know, the return consists of income and capital appreciation. We will consider the income. We will consider the capital appreciation. Simply find the answer. So we have market price. As we discussed just now, the current market price that is given as 106 is including the bonus debenture, whereas the future market price that is given is only for the equity share. So how much is the appreciation? How much is the dividend? And the return, the probability, expected return. Expected return we found to be 12. We need to find the variability of returns. So we have the return, we have the deviation, we will square the deviation, multiply with the probability, get the standard deviation. Now, whether or not to accept the buyback offer depends on whether the portfolio requires a rebalancing or not. What is the position? Actually, the advice is regarding the buyback offer of the debenture. But what we have found is the return and risk of equity. What is the return of equity? 12. It is 12% as well as 12 rupees because the base is 100. What is the standard deviation? 8.49. You have a 12% return with a 8.49 standard deviation. When you look at debentures, it gives you a 10% return, but there is no variability. So, if you do not want any variability, you get a 10% return. If you are okay with variability of 8.49, you get a 12% return. What you want depends on what is the asset allocation, whether a rebalancing is required now, all those things. So whether to accept the buyback offer or not depends on whether the portfolio requires some rebalancing. If so, you will do. Otherwise, not necessary. That will be your decision. If you are through with this, we can move on. The next one, the problem number 3 was about buyback of debenture. Problem 4 is about buyback of equity. Let us go to the requirement first. Determine the price at which shares can be repurchased if market capitalization of company into calculate the number of shares to be repurchased. Show the impact of share repurchase on EPS, assuming same net income. Now, what do we know about buyback? Yes, what do we know about buyback? Why companies go for buyback? There are many reasons why companies can go for buyback. When companies want to signal that their share are undervalued by the market, they will go for buyback. For buyback, they need to have surplus cash. When you buy back, because you are using surplus cash, which is not generating any return, the normal assumption is that earnings do not get affected. If the earnings are not affected, but the number of shares are coming down, it will increase the earnings per share. Now, when companies have generated profits, they have cash, they can invest in the business to earn it. If they do not have enough investment needs in their own business, they can acquire some other business. If that is also not possible, they might as well return the money to the investor. This money which they return can be returned as dividend or can be returned to the equity shareholders by buying back their shares. You give us return, when you return it as dividend, the problem which you have is that investors would expect a high dividend every single year. Therefore, you might choose to, if you have surplus cash, where you do not have enough investment opportunities, you might choose to buy back the shares so that you will get the same earnings on a lower investment base. And that would be better for the equity shareholders because there will be an increase in earnings per share. You know that the fundamental objective of financial management is maximizing shareholders' value, which is represented by the market value of shares which they are holding. So increasing the market price is a fundamental objective, primary objective of financial management. If the earnings, you know that market price is a function of earnings per share and price earning ratio. So if the earnings per share increases, price earning ratio, the market price will increase. That is the idea. You can try this and we'll discuss. What does the problem say? There is a surplus cash that can be distributed. They plan to distribute 30%. So what is the cash to be distributed? Buyback price, you are supposed to determine. They have asked you to find the buyback price. Determine the price at which shares can be repurchased. So I don't know that. I will take it as X. You know the amount to be used for buyback. Therefore, you can frame an equation and solve. Surplus cash is 90 lakhs, 30% is to be distributed. So 27 lakhs is to be distributed. Buyback price can be taken as X. So number of shares bought back. Before buyback, I know. So after buyback, I can find. It's given in the problem that post buyback, the price will be 10% above the buyback price. So market capitalization after buyback, I can find. That is the price into number of shares. After buyback, I know what is the market capitalization. Because the problem says it will be 200 lakhs. Frame an equation, solve the buyback price. Now when we solve, we find that it is 20.8. Next, we have to compute the number of shares to be repurchased. Amount is known. Price per share is known. Find the number of shares. So once you know the number of shares to be bought back, number of shares after buyback we can find. Earnings before buyback is there. The total amount is not going to undergo a change. We already saw. So what is the earnings per share after buyback? Take the total earnings, divide by the number of shares. That will give you earnings per share. The buyback has resulted in the earnings per share going up by 45 paise per share. Next, we will be discussing sustainable growth rate. Now, what is the requirement of the question? Draw income statement, calculate sustainable growth rate, find the fair price. Should you invest? These are the requirements. What is sustainable growth? Now, first of all, whenever I talk about valuation, I want to find the worth of another. I have to consider the return. I have to consider the risk. Value of an asset, when you have a constant perpetual income, would be income divided by required return. The perpetual valuation models for an asset with perpetual growing income, I can find. This is the Gordon's model, which I told you some time back is the most important model for any valuation. Now, normally, companies have an ideal capital structure. They do not like to disturb the capital structure. Sustainable growth rate is the maximum rate at which the company can grow without having to raise new equity or increase its financial leverage. So, the company has an optimal capital structure. They want to grow. What is the maximum rate at which they can grow? But they should not disturb the capital structure. They are not interested in issuing fresh shares. Whenever companies want to tap capital, the easiest source is retained earnings. After that is debt. Equity, they have a lot of procedures to follow. So the sustainable growth rate, we are trying to find what is the maximum rate at which a company can grow without raising fresh equity and also maintaining the structure. There are certain assumptions based on which we have the sustainable growth rate. Sustainable growth rate, you would have already done Gordon's model. What we have in Gordon's model, we will take D1 divided by K minus G. The G that is the sustainable growth rate. G is equal to retention into return on equity. G is equal to BR. B stands for retention ratio. R is the return on equity. There are certain assumptions for the sustainable growth. What are the assumptions? Investment policy is stable. Yes, the company maintains its existing asset turnover. So sales will grow at a constant rate and profitability. So operating profit will grow at a constant rate. Therefore, return from capital employed will have a stable growth rate. Financing policy is stable. The company is maintaining its current capital structure. We already saw that. Management is unwilling to issue equity. So earnings for equity shareholders will also grow at a constant rate. Return for equity will have a stable growth rate. Then, and further assuming dividend policy is stable. So if the company maintains its dividend policy, retained earnings will also grow at a constant rate. So sustainable growth rate is helpful for us in determining what is a realistic growth rate. So that is what we are going to do. We are going to do a problem on that. First, please try drawing up the income statement. We have information regarding assets. Asset turnover is given, so we can find turnover. We have two types of debts, debentures and bond. Effective interest rate is given. We can find the interest per annum. Operating margin is there. We can find the operating cost. Equity capital and reserves and surplus are given. So we can find the total capital. So this is the base working which we require. Is this done? Shall we move on? Going to the income statement, turnover is there, operating cost is there. We can find the operating profit. Deduct the interest, we get earning before tax. Deduct tax, we get earning after tax. Dividend payout ratio is there. We can find dividend and retained earnings. We are interested in the sustainable growth rate. Sustainable growth rate is retention ratio into return on equity. Earnings for equity shareholders is there. Equity funds is there. We can find return on equity. Dividend payout is given. We can find retention ratio. and then sustainable growth. Fair price, we will use Gordon's model. Gordon's model is a very important valuation model. So we have dividend per share, the expected so D1 divided by KE minus G. D0 is equal to D1 divided by KE minus G. Fair price is only 6.52. Current market price is 14. Am I interested? Not interested. Why would I pay 14 rupees for something which is worth only 6.52? I'm not at all interested. So the decision is investment should not be made. Next, we can have a discussion on free cash flow. That's what we are going to discuss next. What is free cash flow? Now, the name itself tells you free cash flow. Free means after financial commitments towards future investment needs, either to maintain or expand the asset base, you will set aside after that what is available cash. So I'm not looking at accrual, I'm not looking at profits. I want to look at cash. So what will I do? I will deduct non-cash income. I will add non-cash expenditure. Because it is cash which I'm looking at, both capital and revenue items will be considered. Flow. So cash generated during a period which flows from the investment. Free cash represents the cash that a company can generate after setting aside cash required to maintain or expand its asset base. Have you understood what is free cash flow? Free cash flow represents the cash that a company can generate after setting aside cash necessary to maintain or expand its assets. When we say free cash flow, we could have two things: free cash flow for the company and free cash flow for equity. For company, now if you are valuing equity, we will take free cash flow for equity. If you are valuing a company, you will take free cash flow for the company. The free cash flow for equity is the cash that freely flows from the company to equity shareholders after meeting claims of all other stakeholders. Now, free cash flow is important because it allows a company to pursue opportunities that enhance shareholder value. We are interested in shareholders' value. So, a company, it requires free cash flow for many things: to develop new products, to make acquisitions, to pay dividends, to buy back shares, reduce debt. Now, all of this is going to influence the value. So, free cash flow for equity, what we should do? We should consider free cash flow for the firm and adjust for any debt borrowing or debt repayment, and then arrive at the free cash flow. Would you like to try this problem? Let us see what is there in store in the problem. We have profit for the company. Profit for the company means what? Profit after tax. Now, equity capital is given, par value is given, debt ratio is given, long run growth rate for the company is given, beta, risk-free interest rate, market. The moment we see beta, we know we are looking at CAP, capital. Cost of equity using capital would be RF plus beta into R minus RF. Then capital expenditure is given. Is that an outflow? Yes. Depreciation per share is given. To the extent of depreciation, there has not been a cash outflow, so cash will be more by that amount. Change in working capital is given. Now, change in working capital can be increase or decrease. What is it in this case? Is this change in working capital an increase in working capital or a decrease in working capital? When the activity level is increasing, working capital also will accordingly increase. Therefore, this is an increase in working capital. An increase in working capital, is it an outflow or inflow. Increase in working capital is obviously an outflow. So, how do we go about this? What is the free cash flow? And we are interested in the intrinsic value. The requirement of the problem, find the value of the share. They have not said using free cash flow, but we need to infer that it is using free cash flow. If you look at the problem doesn't mention that we have to use free cash flow, but we have to infer that we have to use free cash flow because you are given capital expenditure, you are given working capital. So all this indicate that we have to use free cash flow. Let us say, what is it we have? Equity capital of the company is given. Par value per share is given. Number of equity shares we can find. Once we find the number of equity shares, profit after tax is given. So profit after tax divided by number of equity shares will give us earnings per share. This is the earnings per share. Capital expenditure per share is there. Increase in working capital per share is there. Depreciation per share is there. Therefore, net additional investment that is required is 7.5. Capital expenditure per share is an outflow. Increase in working capital per share is an outflow. Depreciation per share is an inflow. So net additional investment per share. So we know that for sustainable growth rate, there are certain conditions, there are certain assumptions. You do not want to disturb the capital structure. So debt ratio is given. If additional investment is 11.45, 27% should come from debt. Balance 73 should come from equity. So let us see what is the additional investment per share from equity. Free cash flow will be whatever is the earnings per share minus the additional investment per share from equity. So that will give us the free cash flow. Now, once we have the free cash flow, we can find the value of the share, for which we require D1 divided by KE minus G. KE, G is given straight away in the problem. G is given to be 8%. KE, you see. So what is my KE? So now we have free cash flow for year 1. And then we have the growth rate. We can find what is the intrinsic value. How do we go about it? The free cash flow, what we have is for the past year by the growth rate. We get free cash flow for year 1. KE we found, G is given, so you can find. So have you completed? Have you understood? With regard to equity, we have seen few concepts. First, we discussed regarding bonus issue. Then we looked into buyback. We looked into buyback. We looked into buyback of shares. Then, of course, we have looked into sustainable growth rate. Then, as a continuation of sustainable growth rate, we found how to find the intrinsic value using free cash flow. Now, this Gordon's model, we are interested in finding the intrinsic value. How will we find the intrinsic value in the Gordon's model? We will take a measure of return. If it is a perpetual, stable return, we know we can have A by R. If it is growing, then it will be A divided by R minus T. If we are valuing equity, the A has to be a return which goes to equity. The R has to be the cost of equity. The G has to be the growth rate and the return for equity. what can be considered as the return for equity? Dividend can be considered, earnings can be considered, a combination of dividend and earnings can be considered, free cash flow can be considered. Any of these can be the numerator. That should be for the forthcoming year, divided by KE minus G. Yes. So, are you comfortable with what we have done today? Is it clear? Okay. So that brings us to the end of today's session. We will meet tomorrow.